The stock market has never been this high in all of human history. Trillions of dollars are being added to valuations every month, while economies across the world quietly sink into debt, unemployment, and decline. In 2024 alone, U.S. markets added over $7 trillion in paper wealth, even as real household incomes fell for the third consecutive year and bankruptcies surged to levels not seen since 2010. At the same time, global debt surpassed $315 trillion, a figure so enormous that it equals more than 3 times the total annual output of every country on Earth. Yet investors cheer, politicians smile, and financial commentators call it a miracle. But it's not a miracle, it's a distortion. What we are witnessing is the largest and most dangerous financial illusion in modern history, a mirage created by cheap money, debt-driven speculation, and central banks desperate to keep the system alive. Beneath the celebration, the real economy is cracking. Factories are slowing, wages are stagnant, and families are falling deeper into debt, while the markets float higher and higher into a reality that no longer exists. And yet that's only the beginning. To see what's really coming and how to prepare, make sure to stay until the end, leave a like, and let's start. For most of history, the stock market was seen as a mirror of the economy. If the economy grew, the market rose. If production slowed, the market fell. But over the last 2 decades, this relationship has quietly broken. The stock market no longer represents factories, workers, or production. It represents liquidity, leverage, and the movement of capital searching for yield in a world drowning in debt. And the numbers tell the story better than words ever could. In 2024, the total market capitalization of U.S. equities surpassed $45 trillion, almost twice the size of the entire American economy. The so-called Magnificent Seven, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, and Nvidia, now together command a combined valuation of more than $19 trillion, more than the combined GDP of Germany, Japan, and India. Nvidia alone, a company that produces microchips, reached a valuation above $4.4 trillion, making it worth more than the economies of entire nations. To put that in perspective, Nvidia's market value exceeds the total worth of all farmland in the United States. It's extraordinary, but also absurd because while technology has undoubtedly transformed the world, no single company can reasonably represent such an immense share of global wealth. Yet investors continue to pile in, not because they believe in production, but because they believe in momentum, and because the system rewards belief over logic. To understand how we arrived here, we must look at the evolution of money itself. After the collapse of the Bretton Woods system in the early 1970s, currencies were no longer tied to gold. Money became elastic, expandable, something that could be created without limit. This shift fundamentally altered how economies functioned. But the real turning point came in 2008, when the global financial system stood on the edge of collapse. To prevent a depression, central banks injected trillions of dollars into the system through a policy known as quantitative easing. Interest rates were cut to near zero, and new money was created with a few keystrokes. It was supposed to be a temporary emergency measure. Instead, it became the new normal. Over the following decade, the world's major central banks collectively printed more than $20 trillion. The Federal Reserve's balance sheet alone grew from less than $1 trillion before the crisis to nearly $9 trillion by 2022. This flood of liquidity did not flow evenly through society. It went first to those closest to the source: large banks, corporations, hedge funds, and wealthy investors. Economists call this the Cantillon effect. Those who receive new money first can spend it before prices rise, while everyone else faces higher costs later. The result was 2 kinds of inflation: asset inflation, which made the rich richer through soaring stocks, bonds, and real estate, and consumer inflation, which eroded the purchasing power of everyone else. For over a decade, money was practically free to borrow. In Europe, interest rates even turned negative. Companies discovered that instead of investing in productivity or innovation, they could simply borrow cheap money to buy back their own shares, reducing the number of stocks in circulation and artificially inflating their price. Between 2010 and 2020, U.S. corporations spent more than $6 trillion on stock buybacks, $6 trillion that could have gone into research, wages, or long-term growth. The illusion of prosperity was complete. Share prices soared, executive bonuses multiplied, and balance sheets looked strong. But underneath, debt piled up. By 2024, total global debt reached over $315 trillion, roughly 330% of the world's GDP. Every dollar of production now sits on more than $3 of debt. That's not sustainable. It's leverage on leverage, and it has created a world where numbers can rise forever as long as belief holds. But belief is fragile. The disconnect between Wall Street and Main Street has never been wider. Across the United States, over 60% of households live paycheck to paycheck. Credit card debt surpassed $1.3 trillion, dollars, the highest level in history. Delinquencies are rising again. The average 30-year mortgage rate sits above 7.5%, doubling housing costs for new buyers compared to just 3 years ago. Meanwhile, the real median household income, when adjusted for inflation, has barely moved in 20 years. For millions of families, the dream of owning a home, saving for retirement, or building wealth has become a fading memory. And yet, the stock market continues to celebrate record highs. Why? Because it is no longer a measure of value. It is a measure of liquidity and expectation. As long as central banks keep the flow of money alive, prices rise. And when the flow slows, the market panics. We see this dependency in every reaction. When the Federal Reserve even hints at lowering rates, the market rallies. When job numbers weaken, investors cheer. Because bad news now means good news. It means more stimulus, more liquidity, and more cheap money. This inversion of logic has turned the financial system into a casino where economic pain is rewarded and real progress is ignored. Between 2009 and 2023, the S&P 500 rose by almost 400%, while US GDP grew by just 60% in real terms. Productivity growth stagnated, but corporate profits, fueled by financial engineering and cost-cutting, kept rising. Even professional investors admit the distortion. A 2024 Bank of America survey showed that 91% of fund managers believe U.S. equities are overvalued, yet most remain fully invested because they have no alternative. In a world where holding cash means losing value and where bonds yield less than inflation, everyone is forced to play the same dangerous game. The result is a self-reinforcing loop, a system addicted to its own illusion. The consequences go far beyond finance. Asset inflation has reshaped society itself. Home ownership is increasingly out of reach for younger generations. The gap between those who own assets and those who do not has become the defining divide of our time. In 1989, the top 1% of Americans held roughly 23% of total household wealth. Today, they control more than 32%. Meanwhile, the bottom 50% share less than 3% of the nation's wealth. This concentration of power is not an accident. It's the direct result of policies designed to inflate assets, not incomes. The system rewards those who already have capital and punishes those who live off wages. As prices of everything rise, housing, education, healthcare, the middle class is being squeezed from both sides. It is a slow erosion, not visible day to day, but unmistakable over time. And yet, people are told that everything is fine because the market is up. But markets can't feed families. They can't lower rent or reduce the cost of energy. They are not the economy. They are a reflection of speculation fueled by the belief that someone else will always buy higher. This is the essence of the great financial illusion. We've built a world where paper wealth grows faster than real wealth, where numbers on a screen rise faster than productivity, and where confidence replaces value. But confidence can evaporate overnight. One shock, a debt crisis, a geopolitical event, or a sharp rise in interest rates could unravel the illusion. When that happens, trillions in paper wealth can vanish in weeks, revealing how fragile the foundation truly is. History shows this pattern repeating again and again. In the late 1990s, the dot-com bubble drove markets to unimaginable heights based on dreams of technology that didn't yet exist. When it burst, the Nasdaq fell 78%. In 2008, the housing bubble, built on cheap credit and speculation, nearly destroyed the global banking system. Each time, the illusion ended the same way, with disbelief. People always think this time is different, but it never is. What's different today is the scale. This isn't a single bubble, it's an everything bubble. Stocks, bonds, housing, and even cryptocurrencies inflated together, all resting on a foundation of debt. And because it's global, the consequences of its collapse would reach everywhere. When faith in the system finally cracks, it won't be a gradual process. It will be fast, chaotic, and psychological. Because markets are built not on assets alone, but on collective belief. If that belief fades, numbers will collapse back to reality, and reality always wins in the end. The great financial illusion may continue for a while longer, perhaps months, maybe years, but it cannot last forever. The higher it rises, the more fragile it becomes. Every illusion in history has one thing in common. It lasts until the moment it doesn't. And when this one breaks, it won't just reset portfolios, it will redefine trust, wealth, and what people believe money actually is. In the end, the question isn't whether the illusion will end, but what will come after it. Will we rebuild a system grounded in production, innovation, and value? Or will we keep chasing numbers on screens, hoping they mean something real? Because no matter how high the market goes, no matter how strong the illusion seems, reality always brings it back to earth. And when it does, we will finally see the truth that the stock market's incredible rise was never a story of economic strength, but of human belief, financial manipulation, and the dangerous beauty of an illusion too big to fail. Let me know your thoughts in the comments. Subscribe to this channel and see you soon.